Welcome to Block Time by Riot. Today we're joined with a special guest, Parker Lewis. Parker, welcome.
Thanks for having me on, Pierre.
Of course. I mean, you're based in Austin, so it was an easy ask. And I also wanted to hear about what you've been up to lately with Zaprite, with payments. So yeah, welcome and thanks for coming on.
Yeah, it was an easy trip up from Austin. You know, growing up here, Austin and Round Rock are basically the same place. So,
do you consider yourself mayor of both, or just are there city limits?
I feel like that would be assumptive.
Yeah.
You know, there is part of Austin in Williamson County, so you know it comes up right around here. But to claim mayorship of Round Rock would be, you know, a step too far.
It would have to get incorporated formally through a process there. For those who don't know, Parker Lewis is the honorary symbolic mayor of Austin.
The future mayor. Symbolic future mayor of Austin.
That we ought to have. But anyway, won't wade into politics on the company podcast. So yeah, you've been in Austin for a while. You were at Unchained. I think you still are as an advisor.
Yeah.
And give us a little bit of your background before you really got into Bitcoin head first.
Yeah. So my background was more in traditional financial services. So started out in investment banking on Wall Street, worked in M&A, and that was from 2006 to 2009 in New York. Transferred from there to working in restructuring. It was when the world was blowing up. Figured there was a lot of companies that needed to be restructured. Would be a good point to graduate to. So worked a lot on the creditor side of restructuring as well as on helping companies from the management side of restructuring, turnaround management. That just kind of serendipitously, wasn't looking to go work for a hedge fund, but found myself working for a hedge fund that was investing in companies that I was restructuring. And it was really there in that time frame between 2016, 2017, 2015, 2016 when I started going down the Bitcoin rabbit hole. And I really, kind of found myself going down two different independent paths of research. One completely, or at least at the time, what I thought was separate from Bitcoin, trying to understand what would happen to a broad set of financial markets when the Fed started to unwind post-2008 financial crisis QE. That led me to a conclusion that they were always going to have to print more money and that was a problem. Coinciding with that, I started to become interested in Bitcoin. Only later, as I figured out what Bitcoin was and why it was valuable, did I figure out that the other side of my research of the Fed printing money was kind of more intertwined with Bitcoin than I could have known when I set off on either of those two paths of research. But that was about the, kind of when everything started to click for me was 2016. Ended up leaving the hedge fund that I was at in 2017 to work full-time on Bitcoin. Ended up joining very early a company called Unchained that's based here in Austin that's really focused on Bitcoin custody and financial services, helped build that from a very early stage to a more developed stage, and took a step back from that just about a year ago to finish my book called Gradually and Suddenly that'll be coming out this month. And now, as you mentioned, I'm working on Bitcoin payments at Zaprite.
Awesome. Well, congratulations on the book and the new role.
Never want to write one of those again.
Well, maybe if the sales are appetizing, but then you start writing books for the sake of writing the book rather than the actual thought you're trying to get out in the world. But I'm looking forward to reading. And I also wanted to ask, you mentioned about the Fed, that you came to the conclusion that they've always got to be printing more. And this was, you're saying like 2017, 2018. And I think that because of COVID, people forget that in 2019, there were some issues in financial markets that in that winter that, were possibly without COVID would have been a tipping point into another financial issue, but all the COVID money printing covered it up basically. So
yeah, so I would say, to provide some context for folks, from 2009 post 2008 crisis to 2014, the Fed inserted about $3.6 trillion in new base money into the financial system. In 2017, they started to withdraw that money. So from about September of 2017 to September of 2019, the Fed had taken out between 700 to 800 billion of those primary kind of building blocks of liquidity dollars that they had put into the system. In September of 2019, what you're alluding to, the financial markets functionally broke, particularly the repo markets, which is a large overnight funding market. I think it's in the order of magnitude like 1.5 to 3 trillion in funding happens through that repo market. And what essentially happened was the repo market rates, the rates that a lender, if they were willing to lend into that market, was charging, tripled overnight. It went from somewhere between 2.5 to 3% to 10%. And that's when I say like a market's broken, like something broke when an overnight lending market has an interest rate that goes from 3% to 10% in a single evening. The Fed the same day came in and provided emergency funding to that market of $75 billion. And for context for people, post 2008 crisis, they were printing or digitally creating 85 billion a month. I think it was 45 billion in purchases of treasuries and 40 billion of mortgage-backed securities. But that was over the course of 30 days. So 2019, before COVID was an inkling in people's mind, in a single day they came and had to inject 75 billion to basically rescue that market. Then over the course of the next 6 months, they had provided about 500 to 600 billion in new liquidity, again, before the government shut down in March of 2020. And I always do remind people of that fact that the repo markets broke. There was an oil war that had been kind of set off. So there was a massive imbalance in the oil markets in February, basically Iran, or I think Saudi Arabia and Russia basically saying, we're not going to cut. And that started to cause the collapse of oil, where it ultimately would go, for a technical reason, below zero. But those two things and those massive imbalances that existed in the market, they were there pre-COVID. And then COVID comes along and everyone associates the money printing with COVID.
Yeah.
But it was really that the financial markets always persist in this incredibly fragile state because of the degree of system leverage. And they're always going to have to paper over it by printing money to save the credit market. It's more of a, you don't know what exogenous shock is going to happen. You just know that one will happen as a function of time. And you know that they will happen because the system is as leveraged as it is. It's like the system is fragile because of that leverage, not because some event comes along to allow everybody to find out that fact.
Why is it fragile? Being credit based, being so highly leveraged.
I mean, the way I help people understand it is, and this is what when I was going down this path of research in 2016, I basically went back to the beginning of the original 2008 financial crisis to try to understand why they had to put money in the system in the first place. And the way that I help kind of contextualize it for people is, at that point, 2007, end of 2007, there was about $53 trillion in very vanilla debt in the U.S. credit system-wide. So federal, state, local, corporate, financial sector, non-financial sector, and that's all like fixed liability, fixed maturity debt. So I owe, a credit card bill at the end of the month, or I have a student loan, or I have a mortgage, not derivatives, not pension liabilities. It's just very vanilla debt. So there was 53 trillion of debt at that point in time. There's only $1 trillion total, and there was only $350 billion that existed in the banking system. So 53 trillion of liabilities to, in the banking system, only $350 billion. So just there aren't enough dollars to go around. And when everyone starts to figure out that the system is far more than just $1 short or $10 short, that everyone starts to hit the exits for the same time or at the same time, and that ultimately causes this cascading effect that is credit markets breaking. And that's essentially what started to reappear in September of 2019, and then was exacerbated in March of 2020, which ultimately resulted in the Fed coming with $5 trillion of fresh money printing, $3 trillion between March of 2020 and May of 2020, and $5 trillion total between, essentially September 2019 to September 2021.
And then they pivoted to, okay, now we're worried about inflation, started raising rates.
Yeah.
Where do you think we are in the cycle now?
I think we're about at that September of 2019 period where they walked into a buzzsaw. It's very difficult to predict what next thing is going to break because generally the Fed has eyes on the last thing that they broke. But the system is incredibly complex, and they're basically back in that same position of, the debt system is now larger today. They're in the process of starving the financial system of liquidity and causing liquidity to cost significantly more than it did a year or 2 years ago. And kind of I describe it as the Fed walked into a buzzsaw in 2019. They're in the process of walking into that same buzzsaw. In the reality of the situation is that system or the early marker already seems to have broken. That was the bank failures that people have seemed to forget about just from 6 months ago.
Yeah.
And we're kind of setting up the same issues that caused those bank failures continue to persist. And every day that they continue to persist, it's just an inevitability between now and when the next thing breaks.
And it seems like the bank failures are one. If you increase interest rates, then the value of the debt that was out there existing decreases, right? Just bond prices. And then two is the quality of the collateral. So one, I think, matters for treasuries and banks holding treasuries. But two, the quality of the collateral for commercial real estate, that eating away at the equity of banks.
Yeah.
And there's not really a path to improving that, given just there seems to have been a shift away from working in offices.
I mean, the only path to improving that is for the Fed to print money to basically cause the value of the collateral to go up, the value of the debt to be able to be repaid. And that's where it all originates from, the money printing. It's basically they break the credit system by withdrawing dollars and raising interest rates, which necessitates that they come and print more money to basically buy debt instruments to reduce interest rates to allow existing debt levels to be sustained. In order for existing debt levels to be sustained, they need existing asset prices to sustain those. And then that sets off this new wave of debt creation that necessitates ever more money be created in the future. And it's a vicious cycle.
Yeah. So I think it raises the question on the Bitcoin side. I think that mainstream commentators will take what you've said and looking at Bitcoin, they'll come to the negative conclusion that with Bitcoin, it's 21 million cap and kind of the limited supply. It's always in a situation of constraint, right? Of it's permanently hawkish, and that you can't get any economic growth because there's no ability to have credit, financing new enterprises. What are your thoughts on that line of thinking?
Yeah, I think it starts from a perspective of fragility and then assumes that will always be the case. And what I put back to those people is to say that the fragility is a function of the system that exists today, that each time we get through a cycle of, maybe somebody speculated when they shouldn't have, rather than taking the pain on a short-term basis and allowing broad system or industries to restructure and to eliminate bad debt, the point of fragility where we are today, where the Fed and the people who manage the money printer always feel like they're in a position where they have to be palliative to provide more, that fragile system would not exist if not for the ability to always come and provide more money to it.
So taking it, it's like if in 2008 they had just let the financial system go bankrupt, right, and restructure, that much akin to what happened, let's call it in the crypto sector, with this last, bear market of FTX did not get bailed out, BlockFi, et cetera, others. So basically the idea is that going forward, people will be much more cautious about how they interact with Bitcoin in order to avoid the future FTX or Mt. Gox if we really want to go back. Whereas in the fiat system, they don't learn that hard lesson and they just keep making that same mistake over and over.
They keep making the mistake over and over, and it actually causes the mistake to grow and causes the system as a whole to become more fragile. Like the example of what happened in Bitcoin, in 2021, 2022 is a perfect example of that, because when you take the control out of, a human's, finger of being able to print more money, Bitcoin worked exactly as it was supposed to. Some bad actors went bankrupt. People who took inadvisable risk, who were depositors or had, I guess they weren't technically deposited, but they held their Bitcoin with a BlockFi or an FTX or a Celsius. Those people that took that risk, whether they understood it or not, they were ultimately the ones that bared the risk. The people who didn't. Those people who did and those people who didn't learned and had that lesson reinforced, and we move forward. And it's not to say that people don't make other bad decisions in the future, but this process of constantly basically eliminating imbalance and making sure that by eliminating the human element of there's no human to come bail people out with printing money, it ensures that the market has to learn, and that only those that bear the risk basically then bear the cost on the other side.
That makes sense. So in other words, I mean, the fiat central bank system is redistributing from savers who were responsible by diluting them and printing more money to give to those who were irresponsible and made bad investments.
Right. And also for those people, because like I oftentimes kind of, it is a key hang up for it's somewhere between a Keynesian academic to really a lot of Wall Street finance types think of this same quandary of, well, but if you can't provide more money to the system, like that's what actually lessens the pain. And it's that it only lessens short-term pain. It causes long-term instability and unviability of the system. So you basically suppress volatility and then cause, far greater volatility down the road, which ultimately comes in a currency failure. And the thought exercise that I take these people through is to say, the existence of Bitcoin does not eliminate the idea of a lender of last resort, like a central bank. All it does is require that you would actually have to capitalize that entity.
Right.
You'd have to create a rainy day fund and say, okay, we want to still have a Fed, but how are you going to fund the Fed? Well, you got to do that via taxes. Well, taxes are not popular, but there's nothing that says that the Fed can't exist without Bitcoin. It just means that you actually have to capitalize it. The way that you would capitalize an entity like that would be via taxes. And if you did that and they lent poorly, you can only lend once, because what we're actually eliminating is not the Fed. We're eliminating the ability to print money. Now, it so happens that an entity like that probably also goes away, but not for the reason that they think it does, but it's more for the fundamental that, well, this idea of printing money out of nowhere can no longer exist. And once you actually have to pay for it, it will become so wildly unpopular that the whole activity and operation will go away as well.
Got it. And when the Fed was created, I mean, as the name implies, reserve, like it was supposed to be capitalized with gold. But was it ever? I thought the gold was like technically the U.S. Treasuries.
I won't go back through the whole history of the creature of Jekyll Island, but what I will note is that the very name of the Federal Reserve and system were all very strategic. They wanted to give the understanding or the belief that it was backed, and they also wanted it to this perception to be that it was a system. That like they weren't all just, consolidated in this New York Fed or like DC. The reality is they weren't actually backed, and it, like, even though there was a quote system, the decision making behind that system was all concentrated in one board.
Yeah, I thought it's really funny on the Federal Reserve System website. They say they use the word decentralized. They say, hey, we're a decentralized system, which from a Bitcoin perspective is just ludicrous assertion. But it is marketing. So okay, from there, I think that when we look at Bitcoin and the dollar, there is this view of like, okay, Bitcoin's just digital gold, and just as gold has existed, let's say since 1973 or whatever, 1971, whenever we went off the gold standard, as an independent asset of the dollar, that, some people are like, well, that's always going to be the case. That like the dollar is going to exist as a fiat currency, and then Bitcoin's going to be freely floating against it, but it won't ever have a substitutive effect. Where do you think they're going wrong in that logic?
So I think that, as you mentioned, the dollar has been untethered from gold since the early 1970s. And I think that we've lived in this 50-year period where it's actually a crazier position to believe that the dollar will continue to exist in that untethered state than it will. So like when people, when I say that the dollar will go away entirely just based on, economic forces, the person taking the other position, like I sound crazy when you say that, but then if you actually think about it logically to say, okay, the dollar's only existed in this untethered state for 50 years, what's more likely that untethered state, once you start to actually understand it, continues to persist, or the reverse? And so I kind of like start with saying you're actually taking the crazier position if you believe that suspended state of not being tethered to any physical commodity exists. Then when I come to the Bitcoin side, it's this recognition that Bitcoin is competing with gold, it's competing with the dollar, it's competing with the euro, the yen. It's ultimately competing with all other things that could possibly be being used as a form of money. And if you start to appreciate, because I think the dollar is evidence of it, that money and economic systems converge around a single form. So, it's not a coincidence that everyone in the United States uses dollars. It's not a coincidence that people in Europe use euros, and before that, different jurisdictional fiats, or the yen in Japan. If you start to understand why economic systems converge on a single form of money, and then if you start to develop an understanding that Bitcoin's fixed supply is credibly enforced, it starts to be very logical that the world will converge around Bitcoin. And then, the late stage of that, which was my own late stage of understanding Bitcoin, I had this tendency to want to say, well, we'll use Bitcoin as this digital representation, but we'll back it with gold, or, maybe the reverse. You'll have Bitcoin as the physical scarce commodity and dollars floating on top of it. But the reality is there becomes no actual, I view the dollar as having solved some technical or technology limitation of gold, right? Like while gold was money and emerged as money over thousands of years, it had to be secured in bank vaults and it was difficult to transact. And here comes the dollar that was a fractional representation of gold. And then, you carry that forward over, the better part of a century, and then the dollar is split from gold. But that the dollar could not have existed without gold previously existing.
And there's still survey data that shows that quite a few people still think the dollar is backed by gold.
Yeah, which is not the case.
No, so there's a reputational,
which is objectively.
They're coasting on the reputation. It's basically like an exit scam, right? A con, right? Of like, hey, you build up all this confidence,
yeah,
and then you cash out on the confidence.
Right. And if we think about this, like kind of this analog of, well, back in the day, early 1900s, before, Executive Order 6102, where they banned private ownership, you'd show up with gold and they'd say, hey, here's $20, with the promise that you could show back up with that $20 and get the ounce of gold. So that was the reserve back system. Well, imagine the world where your dollar is losing its purchasing power day after day after day, as we're all observing in the real economy. And then there's this thing, Bitcoin, and it's storing its purchasing power over time. Yes, it might be volatile, but it's storing its purchasing power. Now imagine a huckster comes up to you and says, hey, deposit this Bitcoin in my bank and I'll give you $20. And you'd be like, why would I do that? Because the reality is, why wouldn't I just as well have the dollar? the Bitcoin, because I can send the Bitcoin digitally just as easily as a bank could, right? And so there becomes no logical reason to insert counterparty risk for the sake of having counterparty risk. The only rationale for that was someone to say, well, they're going to make Bitcoin illegal and you're going to have to do that. But even then, I'd just as well keep it under my mattress than, arbitrarily with no benefit inserting a layer of counterparty risk. Once you start to understand that Bitcoin can both be that scarce store of value as well as you sitting with the comfort of your own roof over your head or your own business to be able to send that and receive it without the need for a bank-like entity to wrap it in a dollar or something worse.
Yeah. So people, you mentioned the competition versus other assets, basically like gold, currencies, and then there's the competition against other payment systems, where like with credit cards and debit cards, they've rigged it so that you get this cashback rewards.
I've never understood cashback. Like I don't know what it is. People love cashback.
Yeah,
it's like, wait, so you're gonna just charge me more to give me money back?
It's pure psychology, right? But it works.
It does.
And so that's one of the arguments I've heard against Bitcoin being used as payments, in the sense of using the Bitcoin network or using the Lightning network, is that it's actually engineered to be in the user's best interest, which is to not have cashback. But that because the incumbent system has this psychological, it's a dark pattern, right? Of like, they've tricked people to doing something that's against their interest, that's a limiting factor on Bitcoin's ability to compete on a payments level.
Yeah, I would just disagree because it's also not in the merchant's interest, right? So in that equation, there's a sticker price, and the merchant's paying all these fees, and out of those fees, some of it's being passed back along to the buyer. So it's more observable to the merchant, and the merchant is actually the one, in my view, who is going to drive the shift to Bitcoin payments. And part of those benefits will be passed on to the user or to the consumer. It just will be done in a more honest way, right? So if it's like, hey, if the merchant's sitting there saying, if you pay me in Bitcoin, the price is X. If you pay me in fiat, it's 2-3% more. That will be the way that the merchant communicates to the consumer that, hey, if you want me to continue to take your worst money, you're going to have to pay me more because I'm paying more, And so it's like the idea that merchants will not demand to be paid in the form of money that is better if they can, like that's the irrational position, because it's like, if I think about my position from a consumer, so long as the gas station allows me to pay them in fiat, my depreciating asset, I'll pay them in fiat. And there's going to become a point in time where that fiat becomes so volatile day to day, and look at any country in the world where this is already the case, where the person who's delivering the services does not want to take that volatility risk, and so it will flip. The merchant will say, hey, if you want my gasoline, you're going to have to pay me in the form of money that I'm confident is going to hold its value until I can pay my suppliers.
So basically you're saying that by paying dollars to the gas station today, with your Visa credit card, there's an information asymmetry where the gas station owner doesn't understand why Bitcoin is better. And because of that lack of understanding, is willing to accept dollars. But that once that understanding is there, it might start with like they buy some on Cash App, right? And they're just like holding it. But then it goes into, wait, why don't I get this in at the top line revenue and not pay the extraneous fees, but also have like instant cash settlement, 24/7, like reliability, transparency. I don't have to call the bank and ask them where my money is. Like just look it up on the computer.
It's basically an equity-based system rather than a credit-based system.
Yeah.
trustless versus trust. And the cost of that trustless system is being externalized to good businesses every day. And so, I think about it from, if you think about it from Riot's perspective, the same thing holds. You have your power contracts that are presumably dollar denominated and dollar paid. That's great for Riot, and will be for a period of time. At some point, power producers that are staring at this equation are going to say, hey, you're earning Bitcoin. I'd kind of like Bitcoin too, right? And come back and, not to say we're going to go from a point where like power contracts are dollar denominated and dollar paid to overnight Bitcoin denominated and Bitcoin paid, but the same logic and rationale is there. If there's a reason to hold Bitcoin on your balance sheet as a miner, even if you have dollar costs, there's a reason for the your supplier of power to recognize the same equation. Yeah, I still have dollar costs, but I do want Bitcoin, and this might just be the more efficient way for me to get it.
Right, and the at Riot, our top line revenue is obviously in Bitcoin, and then we hold a percentage of that into our treasury. But even in a business where that's not the case, like let's just say MicroStrategy, right? Their revenues are only in dollars, and then they convert that or cash they raise from financing into their Bitcoin treasury. And so basically, if they were to try to open that door for getting Bitcoin revenue, that saves them the fees of having to convert from dollars into Bitcoin.
Yeah, like MicroStrategy is a great example. Like they've already made the balance sheet decision. I want Bitcoin on my balance sheet. Well, I have this operating business that, to my understanding, is not exposed yet to Bitcoin, but it's the same calculus, and they'll get there. There's some incremental burden to their operation to being set up, right? Like I've got to do some work to receive Bitcoin, but think about if they're selling software around the world, and potentially in jurisdictions that have a particularly weaker form of money than the dollar. The dollar is the strongest of a weak fiat lot. But whether it's Argentina or Russia or Brazil, that like just using as an example, say you get paid in a local currency abroad, say it's Argentine pesos. Well, there's a period of time that you're exposed to the peso. So you have currency volatility risk between peso and dollars until you can actually get the dollars back, right? So you as a business are exposed there. Then once you get it back, then you have to pay the fees to get it into Bitcoin. So if you could just go and say, I don't have to take the local currency risk, the Argentine peso risk, or the dollar risk, if what I want is the Bitcoin, because the reality is when you start to make this shift of having customers start to pay you, not everybody is there from the customer side. You're basically creating the opportunity, but the fundamental decision, the fundamental economic calculus is the same. It just starts to become the more efficient path to get the Bitcoin that actually bears less risk.
That makes sense. So how do business owners come to the balance sheet decision? And they might think of their business as like they are always wanting to extract the cash from the business to go spend on a Lambo or whatever, to basically going from that to a savings mentality of, hey, I'm going to build up a Bitcoin position within this entity. Like, how do you see that? Like, what makes that light bulb turn on?
I really think, again, there's probably exceptions to every rule, but that it tracks the individual's path. And in almost all instances, it's probably the individual that comes first. It's that once an individual figures out why they would want to personally save in Bitcoin, if that individual also runs a business, they realize that the calculus is the same. It might be personal savings versus a business's balance sheet, but really that's just the business's saving. And that just as an individual deals with Bitcoin's volatility, once they've figured out why Bitcoin stores value over time, how do they manage the volatility on a personal standpoint is saying, well, I need to make sure I have my dollar rainy day fund, my dollar working capital, such that, if something unexpected comes up, I don't have to sell my Bitcoin. I don't know how much time that is, Morgan could probably tell us better, but 6 month, 12 month, maybe 2 years, whatever the number is, the personal businesses are just aggregates of individuals, right? And so once an individual understands this is why Bitcoin stores its value, it will do that same operation for an individual just as well as it is a business. And a business has working capital just as an individual does. And so then the challenge for the business is there's more individuals. So you have to gain a consensus across more people. But the calculus and the drivers are very much the same. It would be very difficult for me to imagine a business coming to the decision, I want to hold Bitcoin on my business's balance sheet before the group of individuals that run that business have separately and similarly come to the same conclusion. So I think it's like the individual figures out why it stores value. The same reason why it stores value for an individual will be a business. And then on the business calculus side, it is, say I've got cash on my business's treasury. Riot's a perfect example. I've got dollar costs and I need to have dollars. Nothing about Bitcoin makes the dollar world magically go away, but I hold my dollars and I hold it relative to the amount of my working capital needs are. Pick your time period, but 3 months, 6 months, 12 months, maybe, I don't know what. And then it is, well, I'm going to exist as a business beyond 3 months, 6 months, 12 months. I know that they're printing money. I know, even though I have to hold these dollars, that whatever dollars exist beyond that horizon that I need realistically for working capital, everything else is going to be destroyed in value 12 months, 24 months, 36 months. So I need to be holding my treasury beyond that period in Bitcoin to be sure that I can pay my employees at those longer periods of time and not have my value destroyed. In Michael Saylor's term, he described it as his melting ice cube problem. You know, so it's that combination of just balancing short-term working capital versus long-term store of value.
So basically, once you've got this store of value network effect, let's call it, where on an individual level, a corporate level, and I was reminded of that Mitt Romney quote, corporations are people, man. Yeah. Completely different context, but that
governments are just people, man.
Yeah, well, they're sovereigns, so they have immunity. So I think, but anyway, won't get into the question. The part that I find interesting is really that once you have people making these balance sheet decisions, and they can be acquiring their Bitcoin in an exchange, right, and converting dollars, but at some point that network effect flips into a payments network effect of, well, you already have Bitcoin on your balance sheet. I already have Bitcoin on my balance sheet. We can just, send that back and forth rather than having to deal with converting dollars to Bitcoin back to dollars.
Yeah, imagine you're a US-based company and imagine that you have customers in another country. Just go through the process of like, okay, if I'm going to take the local currency, think about all the steps in the period of time and the cost associated to then, if you actually do want Bitcoin on your balance sheet, it becomes very logical that it's a cheaper, more efficient path to just take the Bitcoin as payment. And I think that the same kind of mental dilemma of like that the Keynesian economist struggles with of like, how can people adopt Bitcoin? It's not money because it's so volatile. They fail in that savings equation to understand that it's not all or nothing. That's like somebody when they decide that they understand why Bitcoin stores value better than dollars, they don't just, exist in a world where dollars don't exist and they can do both. They can save in Bitcoin and dollars. Well, the same calculus exists when you start to make the decision to receive Bitcoin as payment. It's generally not all or nothing. It's going to be 1%, now in Riot's case, 100% of the revenue minus whatever happens on the energy side and hedging. But the primary revenue stream is Bitcoin. That mining equation is separate and unique given the nature of mining from every other business in the world that says, hey, if I opened up the opportunity for people to pay me in Bitcoin, they're not just going to be 100% tomorrow. It's going to be 1 to 5%, maybe 10%, and it's going to be a gradual shift just as savings is. But it very much is a cheaper, more efficient path. And it becomes very logical to a treasurer if they've already gotten to the point where the business has said, well, I want to own Bitcoin anyways.
Right. And for the treasurer, I mean, I think that there's also the challenge of having to track cost basis and like the income tax stuff or the capital gains tax stuff that's going on with Bitcoin. But if they've already accepted that they're going to have to perform that duty because they're going to be holding on the balance sheet, then at that point, like it should be automated such that from an accounting perspective.
Yeah, that's the point. If you've already made that balance sheet decision, you're already dealing with 95% of the complexity. I think that there's also this side that it's like people start to think about, well, every time you receive a Bitcoin payment, there's these tax consequences. As the receiver, like, just as you're not paying taxes each time you receive dollars into your bank account, it's the same thing. You're receiving Bitcoin and you're having some currency change in aggregate over a period of time. That's like one automated software entry, that you can wrap up. And realistically, at the end of the day, you're paying taxes quarterly. So you're managing your balance sheet, not on an individual transaction basis, but in aggregate of like, well, what percentage am I receiving in Bitcoin? What percentage am I receiving in dollars? I'm going to do one treasury, financial transaction, the same as I'm doing on my balance sheet. So it's like when you get into it, it's like there is this mental hang up, but then if you already are holding Bitcoin on your balance sheet, you're dealing with 95% of the same challenges. And so, yes, like inevitably you have to do some, put some other process in place, but it's a pretty lightweight,
Now, on the retail side of somebody spending their Bitcoin, there is hope that there might be eventually a de minimis tax exemption of, hey, you can spend up to $500 and worth of Bitcoin and not have to include it in your capital gains calculation. But do you think that really is a hang up for consumers of like, hey, I don't want to spend this small amount of Bitcoin because then I have to go through the trouble of calculating my gains and losses?
I feel like it's more of an excuse than it is the primary thing. It's like two things can be true at the same time. Yes, like if this capital gains tax did not exist, there'd be more payments. It's not the primary thing holding up.
Yeah.
Bitcoin as a medium of exchange. And so I think both of those two things are consistent with each other. It does create a mental tax to say like, well, if I spend this Bitcoin, am I going to have a tax event? Now, the reality of the situation is if people pay attention to the number of like nominal transactions that are happening on the Lightning Network, like people are dealing with that. People are spending Bitcoin. And it's like, yes, does incremental fiat friction kind of create some, holding back of the dam water? Sure. But there's a need, and people are either going to do what they're already doing where it's, well, buy a little, whatever Bitcoin I'm going to spend, I'm just going to buy it right now. And if somebody comes and asks me questions about it, like I find this to be defensible because I'm spending the specific Bitcoin that I just bought, or the services like Strike where I can spend dollars and somebody can receive Bitcoin on the other side and they deal with the tax issues. The reality is Bitcoin's the best form of money. It's the balance sheet money that stores its value. People are going to demand that. And if there's fiat friction that exists, on the margin, it's going to prevent somebody from taking an action. It's not going to prevent the kind of 800-pound gorilla from being demanded in the market.
Yeah, and I think you already touched on this, but I wanted to lay it out explicitly as there's the tax issue, and then people are like, I don't want to spend my Bitcoin, right? Which is kind of we can debate Gresham's law and what it actually means, but that kind of argument, right?
It goes back to that point of, at the gas station, if they want to take my dollars, I'm more than happy to spend the dollars that I have to them. They want the depreciating asset. I want the appreciating asset. I'll part with my depreciating asset. That's perfectly rational from my standpoint. Ultimately, that from the merchant side, they will get wise to that, right?
Right,
And that's why I
right.
believe that it will be merchant-led rather than consumer-led, because it's like, well, if I show up at the gas station someday, and they're like, well, if you want gas, you're going to have to pay me in Bitcoin. Well, I'm going to part with my Bitcoin because I need the gas.
Yeah.
Like money is a utility to facilitate trade. And so I think that it comes out of necessity. Like, we don't spend money because of the novelty. We spend it not in theory, but fundamentally because we need the goods and services that others sell. And I think that, ultimately people will part with their Bitcoin for things that they actually value. But they'll principally do it once somebody's creating an incentive because the person on the other side actually wants the Bitcoin. I would never spend my Bitcoin out of a novelty, but if somebody who's a Bitcoin holder asks to be paid in Bitcoin, like I'll pay them if I know that they actually want the Bitcoin. I'll go through that problem because on my side, it's like, one, there's a moral dilemma,
Yeah.
but then on the other side, it's like, if I actually value the business owner, I want them to be around. And if they're sending the signal that they want the Bitcoin, I'll pay them in Bitcoin, and I'll take the burden of the fiat friction. I'll do the conversion to get the Bitcoin. I won't spend my Bitcoin, but I'll
Spend and replace.
spend and replace, because all I'm doing at that point is shifting the friction onto a business I value.
Yeah.
And now it might be that I don't value the business, but maybe I shouldn't be spending my money.
Right. Yeah. Yeah. It begs the question. Okay. So you go from people individually adopting store of value, and then that leads to connections of medium of exchange.
Yep.
And then how do you get from that to people using Bitcoin sats for prices rather than just always doing these conversions, even if it's just like an accounting conversion, right, of the unit of account?
Yeah. So I think that it's like people make these individual decisions on the balance sheet side of, at least in this day and age, consciously being able to determine why Bitcoin will store value. Then the population density of Bitcoin holders creates a scenario where there's enough overlap. There's enough density where a buyer and a seller would both potentially have Bitcoin in certain kind of industries and markets will logically go first. But then, I think it's illogical to try to force like the quote unit of account. Like, we're all doing economic calculations, even when we don't realize we're doing them, and they're all dollar based. Like, you can't, it's so ingrained as like, understanding, what I'm going to need to do a month from now, 2 months from now, 3 months from now, probably we're probably doing hundreds, if not thousands of economic calculations consciously or subconsciously every day. So trying to run away from the idea that the dollar is the unit of account and it's how we're all pricing things, even if we're starting to price larger things in Bitcoin, like I won't spend more than X Bitcoin on a house, or a car. That's not making the Bitcoin the unit of account, even if it's becoming that. The way I think it like flips the script is, think about the places where there's hyperinflation. So, Argentina, like, they're not all just scrambling to get Bitcoin. They're scrambling to get dollars because the dollar is working better than the peso. Same thing in Turkey or Lebanon. Now, more people are finding the signal that Bitcoin is the better form of money because of those currency collapsing. But if you see like the second currency that they're using, it is the dollar. They almost prefer
From a
it.
mainstream, like,
Yeah.
plurality of people, even
Yeah.
if you've got a pocket of like 10, 20% who
Yeah.
are,
Yeah.
to Bitcoin.
And so I think that when we shift to this Bitcoin unit of account, only when the prior unit of accounts no longer work.
Yeah.
Now they are related,
Yeah.
but it's something like probably between 5 and 10%. When 5 or 10% of the world figures out Bitcoin, there's a rush for the exit of like, the dollar's no longer holding its value in a way that's like it's losing its value like true hyperinflation, dollar, euro, yen, one of those currencies has to go. And then the world rapidly, the remaining, 90 to 95% of the world, they don't have to sit around and consciously consider why Bitcoin's soaring its value or not. It's the form of money that's working, A versus B. And there's kind of a rapid monetization where things start to be like the prices might be changing, but it starts to be the good that things are priced in because of that.
You brought up hyperinflation. I was just thinking about how the one hyperinflation I've been most involved with was Terra Luna, where I was working at Kraken at the time, and I don't know if you followed the Terra Luna story very much, but basically the value went down 99%, and then it went down another 99%, and then another 99%. And it was just it's something astonishing. But in that case, it was automated. It was like automated hyperinflation, like hard coded into the software. The dollar system, it seems like they are conscious of the slippery slope, and that's why they end up raising rates. Because raising rates, I don't think is ever like in a vacuum politically popular. It just in a vacuum is punitive, unless they really can tie it to fighting inflation, which is also in a vacuum politically unpopular. People don't like inflation for the most part, but they are able to keep the dollar system afloat through this start-stop, oscillation. How does that slip into hyperinflation? Would they have to become worse, more incompetent than they are, or is there ultimately so many times you can hit the brakes and it works?
I think it's more the latter, that we're just at a different point in the curve of these other places. I think that whether it's Argentina or Lebanon or Turkey or Venezuela before that, I'm sure there are other instances that are today worse than we could use examples of. That I think that the breakdown in logic is people believe that the operation in the United States is somehow fundamentally different. Like, oh no, that's socialism. So,
or hey, this is the world reserve currency, so you can't apply any of the heuristics you have from other currencies to this unique situation. Yeah,
I think it's somewhere between there. Yeah. Well, it's the reserve currency, and those people are socialists.
Yeah,
they mismanaged it.
Their institutions
and
are broken. Yeah.
What I draw people back to is that the operation of creating a dollar, a pound, a bolivar, a lira, peso, it's all the same. They're all created digitally. The cost to create $5 trillion was zero. The cost to create 5 trillion bolivars was zero. The cost to produce 5 trillion pesos was zero. So it's like, if the cost to produce all this money is zero, the value of that good is trending towards the marginal cost. That's like probably the most important fundamental anchor. But then I think more like to meet somebody where they're at, to get there, is to say, like, each time they come in and they raise rates, it actually induces the need to print money. That printing money actually causes the ability of the currency to coordinate trade to break down. And that ultimately what happens in hyperinflation is that the currency degrades to such a point that it can no longer coordinate economic activity. Complex supply chains start to break. The two things happen at the same time. Money becomes more abundant when real goods and services become more scarce. And so there's actually a run on scarcity of real goods and services, like the script flips. And so it's like, we don't wish hyperinflation, but if you create, this start-stop, which always ends with more money, which is what happens, human beings figure that out, because ultimately they're just interacting with money to get things that they actually need, like food, energy, healthcare. And so that, when the Fed is raising interest rates, and this is one exercise where it's like, I'm not just being, pedantic, but it's like, think about the Argentine central bank. The interest rate's 100%. Where's that money coming from?
Yeah.
Who's paying for the yield? That they're raising interest rates, but it's the same thing. This idea of arbitrarily creating interest is actually just creating more money supply. They happen to be taking it out of the money supply somewhere else, but it's made more observable for someone when a central bank suddenly increases the interest rate of the Argentine peso as it's collapsing to 100%. They're actually just creating a mechanism to create more money, maybe more similar to that Terra Luna, I'm not sure. But
Yeah.
but when you think about that dynamic, it's that they're trying to create an incentive for people not to spend their fiat currency to tame inflation. It works for a period of time until the problem gets so large where the confidence breaks. And realistically, when people start to be able to observe the price of goods is changing month to month, rather than like, oh, when I was a kid, I remember when a beer cost $1. Now it costs $7. But really, people are starting to observe that the $7 beer is going to be $7.25 at the end of the month. That's when like the confidence in the currency is broken, and that's where it feels like we're at today, where people are starting to be able to observe prices going, the wrong direction on a month-to-month basis. And I think the thing that's scaring these Keynesian academics, and it's perfectly forecastable, is that it's the same time that they're raising interest rates, the inflation's going the wrong way.
Well, the idea behind it raising interest rates is that you're going to reduce demand for loans and create less money. But if the federal government has a $2 trillion deficit, they are price insensitive to interest rates because it's not their money, right? Like they know they're not going to have to pay this off.
Yeah, I mean,
or at least them personally, right?
I think that's part of it.
Yeah.
But the other side of it is that if the demand for things like food and energy, which they exclude from their
right, yeah, to get it down to 2%, yeah.
If those things are inelastic, in the sense of like whether or not you have a job, you need food and you need energy. You might not be driving your car to work, but you got to pay for power, or you're not going to have air conditioning, and you need to eat, or you're not going to sustain yourself. That there's nothing about raising interest rates that suddenly makes food or energy more abundant. It's actually the reverse. And that there's this idea that they think that they can destroy demand for loans, but really what they're trying to do is demand or restrict all demand such that there's then lower demand for loans. And that the reality of the situation is if you destroy, quote, supply, you're going to destroy demand. If you destroy demand, you're going to destroy supply.
Right.
Such that like, people aren't out there creating like excess gas and oil. They're basically creating marginal units based on demand. And so it's like when they destroy demand because they've increased interest rates, well, they're destroying supply at the same time. And that's why it's like, at the same time that they've increased interest rates, gas at the gas station is becoming more expensive. Food at the grocery store is not suddenly coming down. It's only, if anything, remaining at slightly. It's like increasing at a slightly slower pace, because at the same time that if you think about it on a functional level, well, if the Fed increases interest rates to 8%, you think that makes it easier for a rancher to get more cattle to market or a farmer to get more crops to market? No, they're financing their businesses too with loans.
So basically, in your view, the reason why hyperinflation is inevitable is because the tool by which the Fed would prevent hyperinflation, or a central bank would prevent, which is interest rates, stops working at a certain point.
Correct.
And maybe a metaphor that I think about, because we're working on drywall here, is when you screw a screw into a drywall, at some point, if you continue going, you just strip the drywall, right? And then now it's just a loose screw. But what if it is paired on the fiscal side with higher taxes and lower spending and then on the fiscal side, they're running a surplus. that would allow the central bank to get out of that situation, um, of interest rates no longer being effective, essentially.
So, one, I think that we can look at empirical reality and say like that's just not possible, right? So we can live in reality.
Well,
we can,
I feel like
we
that's
can,
political reality, which is
well, right,
yeah,
but
yeah, but that is reality.
yeah, and that kind of in a more theoretical world, I try to like it's like the government, albeit it's one of the largest shares of the economic system because of the reason that they can print money. That I always anchor to like the system in its totality. So, when I kind of explained in 2007 what the dynamics between the total amount of debt that existed in the dollars, it was 52 trillion of debt. Well, post financial crisis, they put in all this money, and that actually the existence of the more dollars induces a credit expansion, which then necessitates more dollars be created. Otherwise, the system collapses. So, to give people kind of that context, is like 53 trillion of debt in 2007. Today, that same figure is 96 trillion. So while the Fed has massively expanded the amount of money that exists, the amount of debt that exists has grown by multiples of that, orders of magnitude. And you can't magically make that debt go away. The Fed is always going to have to provide the dollars to support the credit system, which if they didn't would collapse, and their whole system collapses because it is one that is based on credit, right? So it's like, well, the reality is today there's $96 trillion of very vanilla debt, and there's somewhere like $8 trillion. So it's like, yes, they have printed a shit ton of money, but that mismatch, that massive imbalance is the thing that's going to continue to force them. Otherwise, their system as it exists can't go on. So it doesn't matter if like it doesn't matter if because if you think about what the whole system is, they're competing for both access to credit, but also the base money. So imagine the scenario where that you were explaining, the Treasury says, okay, well, we're going to tax the people a lot more. Well, there's only about $8 trillion of base money today, right? So that would just shift it out of the private sector and into the Treasury, but they're still the same 8 trillion, right? And so anything that creates, but then if you take that money away from the private sector, well, the private sector is going to have a much harder time
servicing that debt,
servicing their share of the debt, So
and even if you framed it as a spending cut, right? All of those cash flows downstream of that federal spending cut, now they would be upside down on their debt servicing abilities.
Yeah. And so the Fed's the one who sets the amount of reserves, but they have to increase it over time because of the function of like this imbalance between debt, dollar-denominated debt, and dollars, because only dollars can pay dollar-denominated debt.
And they'll always prefer inflationary money printing versus deflationary debt destruction.
Yeah, like there's those two scenarios. Like you could, and I say there's two scenarios. There really functionally isn't, because it is a catch-22. Because based on my line of thinking, someone would say, what if they just stopped printing money? And the reality is the dollar hyperinflates even if they stop printing money, because the dollar debt, that 96 trillion versus the 8, the 96 trillion is what is facilitating. It's the primary medium of exchange, the credit, right? And such that like if that 96 trillion starts to collapse on the only 8 trillion of base money that exists, what that functionally means is the business being out of business, the employees being laid off, the real goods and services not being delivered to market. And you create this scarcity because the credit instrument is failing to coordinate
the supply chain.
Yes, the supply chains. And then they start to print money again. And it's like, oh, well, the harm that you've done is permanent.
Right.
And all of this exists at a time where Bitcoin exists, right? Like these two systems are competing with each other. And that's this other dynamic where it's like the Fed has created their bed and they're going to have to sleep in it. But we also have this other system. And as the knowledge distributes, someone's going to say, well, why do I keep playing this game of stop, start if I know the game of stop, start is being played and I can hold a form of money that nobody else can print? Right?
Yeah.
Like, I can't keep the Fed from printing money, but I can opt into a form of money that they can't print.
And if we have this parallel system in place, then the supply chain can continue to function, even if we lose at that point, the vestigial appendix that, hey, we don't need that anymore because we've onboarded everyone onto the new world.
Yeah, and I think that there's probably some reality where, again, not everybody's going to be moved over to the old world when everyone figures out that the old world's not working.
It's going to be messier than that, yeah.
Yeah, it's probably going to be messier than that, but it's also the only viable path out. And that if it didn't exist, it's like everyone has this view of hyperinflation being this like, dark ages type scenario. But like, if you look at examples where, the Lebanese pound is hyperinflating, yeah, like hard for a bunch of people, but there's another currency that they're instinctively, leveraging the dollar.
Yeah.
They're trying to dollarize, right? Well, if there's this functioning currency, Bitcoin, and people just don't understand, the hardest thing about it is not how to use it technically. That's just like picking up the telephone isn't hard to understand. The hard thing about the telephone is understanding what's actually happening to allow you to speak to somebody halfway across the world as if they were right next to you. The hard thing about Bitcoin is understanding why it holds value. Well, if you're just put in an instinctive position of there's this currency that's working and you can use it, that the hyperinflationary event when there's another form of money working is a very drastically different scenario than a hyperinflationary event where there's no form of money as a backup.
Right. Because then you end up monetizing like packs of cigarettes and like stupid stuff.
And you just can't facilitate the coordination of companies, and payroll with cigarettes.
Right.
But
well, maybe you could
in prison
years ago, but
I mean,
or in prison, yeah.
If there were companies, corporations in prison, but you do have this thing, Bitcoin, and that in a world where you need to adopt it to continue to facilitate your business, you will, and it will be the thing that's holding its value when everything else is not.
I think that and we've got only 5 minutes left, but I think that the last objection is it's complicated. So how does Zapwrite make it a lot easier for folks to be able to opt into a parallel system?
Yeah, I think that it's one, we make it easy for people to accept Bitcoin and dollar side by side, because there is this recognition that it's like it will be merchant driven, but a merchant that decides that they want to receive Bitcoin as payment does not want to cut off their nose to spite their face. Right. Like, it's not ideological. It's, I need to build a redundancy into my system. If the answer to that on the Bitcoin side was, well, yes, you can receive Bitcoin via your web store, but you're going to have this entirely different process to receive dollars. That becomes a source of friction that results in many people saying, well, you know what? I'll just take the fiat and convert it to Bitcoin. So we make it easy for people to receive both Bitcoin and dollars. We focus on a certain type of transaction that we think is where kind of early adoption in Bitcoin payments will be. One is on the business invoicing side. The other is on the e-commerce side. That people who are running web stores are going to be more likely than maybe auto manufacturers. People who are contractors offering services in return for a form of payment and billing. That's what I refer to as business invoicing. So if I'm an attorney or a home repair contractor, or if I'm a software developer and I'm working on a contract basis, we make creating invoices and being able to have and demonstrate Bitcoin, kind of basically taking that dollar denominated world, facilitating the Bitcoin payment, and also doing it in a way where we meet people where they're at. So like, money doesn't have to route through Zapwrite. we allow people to connect their wallet. So it's two principal sides: allow you to receive dollar payments or fiat payments side by side with Bitcoin, and being agnostic to how people receive Bitcoin, where we're not inserting ourselves as a source of counterparty risk. Basically saying you can bring a wallet, you can bring a single signature, you can bring a multi-sig, you can bring a Lightning node, you can bring a custodian. However it is that you're already receiving Bitcoin payments, you don't have to trust another party in order to do that. We help you connect in your current rails on the Bitcoin side.
And it's really about getting the data to flow in the right way.
And helping the accounting side, right? Like,
Right.
okay, like we live in a world where, you might denominate things still in dollars, but at that point of the transaction payment, there's a fiat to Bitcoin conversion ratio that's going to dictate a Bitcoin amount, and then logging in all the ways that you might need to take. Well, what if I did 100 of these transactions to take the accounting data to put it back into a QuickBooks or a NetSuite, where you have basically a settlement currency, but then an accounting currency, and being able to help do the reconciliation between all of that on an efficient basis.
All right. Well, it was great having you, Parker. I wanted to have you on in particular. I mean, not just because we're friends, but also because people, they'll say Bitcoin doesn't have utility, right? And what they often mean by that is that they're frustrated that the store of value comes before the medium of exchange. I think that's like the root of what they're basically saying.
I think so too, and I think it should just be like, well, hey, start accepting Bitcoin as payment.
Yeah.
Like they want to be able to go to the gas station and pay, but it's like, hey, you're the business. You figure out how you receive Bitcoin. Everything else will take care of itself. Yeah. That's the actual thing that you can control. And
I've got a Phoenix wallet. I'm ready. Whenever they say. Pull it up. Yeah.
And so that's just the natural way that I think that the shift will occur. And no, appreciate you having me on. I was expecting we were going to talk about how the sun creates price volatility. We'll have to do that at some point
next time. Yeah, next
in the future.
Time. I feel like that's all of our other episodes. I'll be honest. I brought you on to change it up from that.
Well, I'm happy to do that too.
Yeah. All right. Well, thanks for coming in, Parker. And join us next week. I don't know who we'll be talking with yet, but someone. It'll be a surprise guest.
Thanks, Bear.
People can find you at zaprite.com.
Yeah, zaprite.com, zaprite.com. They can find me on Twitter, Parker A. Lewis. And then they can also find my musings about Bitcoin writing, gradually, then suddenly.xyz is my blog.
Awesome. Thanks. Yep. Go check out Parker's blog. Lots of writings going back years. Very prescient. So, yeah, thanks again.
Appreciate it.